Hello and welcome to this week's ADM Grain Market Update. My name is Cameron Curry. I'm the National Head of Feed Wheat Trading for ADM Agriculture. Thank you for joining me today. Since the beginning of March, global grain price action has been largely supportive, having bucked the bearish downtrend that was established at the start of 2024. We are now within a key crop growing period for grains in both the northern and the southern hemisphere, and weather is playing a huge part in price direction as a result. Weather in the UK and large parts of Western Europe has been less than favourable, with heavy rainfall, and is currently impacting spring plantings as well as winter crop development. Winter wheat crops in France, for instance, are rated just 64% good to excellent, which is their worst in 4 years. In the USA, large parts of the country are in fact needing additional rainfall, with around 23% of the Corn Belt currently sat within drought conditions as spring planting gets underway. Comparatively, for American winter wheat, just 18% of this area is sat within drought conditions. And in fact, crop ratings in the USA sit at 56% good to excellent, which for them is a 4-year record. So even between Europe and the USA, we have different outlooks and prospects for wheat crops, which is all adding uncertainty and therefore volatility into these markets. An important week for crop projections with the release of the USDA's WASDE report, as well as some updated numbers coming from some key national bodies, particularly in South America. The USDA figures came out largely in line with market expectations, keeping US and global ending stocks in the 3 asset classes of corn, soybeans, and wheat at comfortable levels. It means that the WASDE report holds a lot of clout for global crop projection, but many private estimates disagree significantly with the figures. This is causing the market to second guess itself. For instance, the USDA kept the Brazilian corn crop production figure at 124 million tonnes, whereas CONAB reduced their estimates another 1.7 million tonnes on the month to just 111 million tonnes. This is a 10% disparity in crop projections, and as a result, the market continues to more closely monitor real-time developments there. From a demand perspective, currency is having a large say in competing origins in the old crop export arena, particularly, with the US dollar outperforming a host of currencies. And European exporters will be hoping to benefit from the relatively weak euro and score some fresh business. But we continue to see Black Sea origins, particularly Russian wheat, looking very competitive and leading the charge to the downside with prices. Domestically, wheat markets remain well defined by inflated premiums to futures markets, particularly in the north of the country and the northwest, which is the market's way of showing us that there's a supply and demand imbalance. Poor crop prospects for the 2024 season are adding weight to the sizable price carry into new crop, which is currently enough to cover the costs of storage and finance into the new season. The old crop market is having to work very hard to keep unsold stocks in the late season positions, which tend to be tricky in order to prevent grains rolling into new crops doing the work rather than futures, which continue to track outside markets sideways. We'll have a heavy reliance on imported grains, both of feed wheat and milling wheat in the new crop season. And today, slow new crop farmer selling and subsequent inflated domestic premiums in the north of the country are pulling the import parity and prices ever closer, which offers a heavy ceiling on price appreciation, full stop. Overall, markets feel delicately balanced, especially given the escalations in the global conflict over the weekend. Huge discrepancies in South American crop production numbers are tough to trade, and when combined with ever-changing weather forecasts in key supply areas, it wouldn't be unreasonable to expect more sideways chop in futures markets. Spikes are being well sold, and dips are being well bought in global demand arenas. Hedge funds still hold huge short positions in grains, which indicates their bearish sentiment, but this can very quickly stop and reverse should the market give it a reason to do so. I hope that's been a useful summary. Please get in touch with any questions or comments, and thank you once again for joining me.